Hello everyone, and welcome back to the Surviving Retirement channel. Have you ever noticed that when the markets go down dramatically, we feel a little sick to our stomachs? We start questioning our decisions, doubt our futures, and swear that the next time we'll do things differently. Well, you're not alone. In 1979, psychologists Daniel Kahneman and Amos Tversky put forth the theory of loss aversion. The idea was that people feel the pain of losses twice as intensely as the pleasure of gains. As a result, we're predisposed to avoiding losses, even if it means passing up on potential gains. Let's try this thought experiment. For example, if you're offered two investment options. Option A, you have a 50-50 chance of winning $100 or nothing at all. Option B, you can have a guaranteed $25 right now just for participating. Even though option A can produce a larger gain than option B, the thought that there is a chance that you could walk away with nothing makes you change your mind. On the other hand, option B offers a guaranteed $25 win. So not surprisingly, the majority of folks will want to avoid any loss and therefore choose option B. This concept of loss aversion sheds light on one of the many cognitive biases we have as investors. Dr. Kahneman's subsequent work gave birth to an entire branch of study called behavioral economics, for which he won the Nobel Prize in Economics in 2002, despite never having taken an economics course. So today, in our last installment of Surviving Market Meltdowns, we'll take a closer look at how the S&P 500 index, which represents the US stock market as a whole, has fared after significant crashes in the past. We'll take a look at how often these crashes happen and how long they last. And finally, we'll have a lighthearted look at how investors behave during these inevitable market cycles and how you can manage through them. Now, before we begin, I'd like to give a shout out to First Trust for providing the graphs that you're about to see. Thank you to them for prioritizing investor education. I'm Peter Guidote, Chartered Accountant, Certified Financial Planner, and Portfolio Manager. So let's get started. So this graph shows the probability of achieving positive returns over different investment horizons since 1937 when investing in the S&P 500 index. Moving from left to right, historically there has been a 63% chance that your investment will have had a positive return after 1 month. But if you extend your time horizon to 3 months, the probability increases to 69%. Now, where the chart becomes really interesting is when we start thinking longer term. After 1 year, the odds of having a positive return are 77%, and over 3 years, the likelihood goes up significantly to 87%. Looking at the 5-year period, there's an even higher probability of positive returns at 93%, and when we look at a 10-year period, we're at a 97% probability. It's no wonder then that financial professionals talk about investing for the long term. More importantly, this chart also asks us to consider what is our investment horizon. Are we after short-term gains or long-term success? And lastly, understanding this graph allows us to parcel out our investments into buckets with different time horizons. If your retirement bucket is more than 10 years away, then you're probably okay to invest in equities and hold it because you have a nearly 100% chance of having a positive return. However, if you have a sum of money that you may need next month, investing in a high-interest money market may make more sense than equities to avoid any potential loss when you withdraw the funds 30 days later. Now let's take a look at some of the S&P 500 worst days and how long it took to recover. Now in this graph you will notice some of the worst one-day drops in market history. Topping the chart is the great crash on a Monday in October 1987, where the S&P 500 fell over 20% in a single day. This day went down in history as Black Monday. However, 1 day later, the index rebounded by over 5%. 1 week later, it was up by 10%, and 1 year later, it had gained over 23%. This graph also shows cumulative returns over longer periods. 5 years after the drop, the index was up 13% annually, and 10 years later, it had gained over 323%, which works out to over 15% annually. So how often do drops like this occur? Well, in this graph of the S&P 500 that is dated March 28, 2024, we see that a market drop of 5% or more occurs about 3 times a year for the S&P 500 and lasts about 39 days. A 10% drop or more, This happens about every 16 months. And a bear market drop of 20%, well, that occurs every 5.5 years and lasts about a year. So what can we learn from this? First, markets are volatile. One should expect markets to fall every now and then, and that a big drop of 20% or more is not at all that unusual. Second, we need to recognize that when this happens, we are likely to feel sick to our stomachs, and that is normal, that is human. Third, we need to take stock of our emotions. Even though we know that on the long term, markets not only recover, but they actually thrive, it can be hard to stay calm and on track. The greatest threat to one's investment success is our own emotions. So have a look at this light-hearted graph from Christian financial advisors and see if you recognize yourself. Now, moving from left to right, you will notice a market cycle that moves up and then down with a correction before eventually recovering and moving on to yet another cycle. But what makes this interesting is that the cycle is overlaid with typical investors' emotions. When the markets are rising, investors are thrilled, and FOMO, the fear of missing out, takes over, and more folks want to buy in. It is at this point that the market is at its maximum financial risk. A friend once told me that when your favorite Italian sports bar changes the channel on their TV from the soccer channel to BNN, that's a good sign that the market is peaking. As the market sells off, fear begins to take over. The pain of loss that we spoke about earlier takes over until you feel sick to your stomach as the market bottoms out. It's at this point that the maximum financial opportunities abound. There are more willing sellers than there are buyers. The catchphrase, buy low, sell high, is really tough to do. So what's the key takeaway here? Well, throughout this series, Surviving the Market Meltdown, we presented historical facts of how the largest U.S. market, the S&P 500, has done throughout both good times and bad. However, we also need to recognize that arming ourselves with facts and figures may not be enough. We need to acknowledge that our emotions play a critical role in how we make decisions. Our human brains are wired in such a way that sometimes we behave in ways that are not always rational. Understanding this can be the key to investment success. In our video entitled The Secret Weapon for Surviving and Thriving in Retirement, we will show you how all the pieces of the retirement puzzle tie in and how this weapon can be used to manage our emotions. If you would like to know more about how our behaviors can affect our choices, I would encourage you to look up Dr. Daniel Kahneman and his work. And if you're looking for a couple of good reads, pick up a copy of his books, Thinking, Fast and Slow, as well as Noise, A Flaw in Human Judgment. If you found this video helpful, make sure to give it a thumbs up, subscribe for more content like this, and hit that notification bell so you don't miss any updates. If you'd like to know more about us, check us out on survivingretirement.ca. Or if you'd like to chat, book your free 30-minute strategy session with a member of our team using the links in the description below. Thanks for watching. Be kind to yourself and others, and I'll see you in the next video.